$25,000 in returns. So the amazing thing about this current market is that the VIX has been just astronomically high, which has allowed us to almost increase the credits that we are receiving on our short positions by 30, 40, even sometimes 100%. And because of that, our returns on our trades have been exceedingly profitable. A $25,000 week is not the norm, and it is based on an account that is over $25,000. If your account is under $25,000 and specifically a margin account, you would have still easily achieved somewhere between $5,000 and $10,000 if you are trading the range of systematic trades that we are making available to you week in and week out. Now we know people don't want to sit next to their computer the entire day. And the benefit of our systematic trades is that they occur at different times throughout the trading day, so you can choose which systematic trades make the most sense for you. For those who are working really complex, very mentally intensive full-time jobs, like people working maybe in the medical field or people who are working in factories where they're required to be on the floor during certain periods, then knowing when you have to put on your trades and how to set up your stop loss and your profit target allows you to be able to come back to your computer, spend 2, 3 minutes to get the trade on, and then go on about your business. And you do not have to take all of the trades in order to be profitable. We have just seen the aptitude of all of our members just continue to increase because of the fact that we are trading the same exact trades week over week. This allows people to see the trades work out in different types of market environments and reduce their sense of stress that they're setting up the trades slightly differently week over week. It's not like that. The rules are the rules. And so each week, week in and week out, you are setting up the same exact trades. There may be some minor variables that will change based on the VIX or based on other market dynamics, but that's based on 5, 6 years of data where we have been trading these trades and trading them in bull markets, bear markets, flat markets, high VIX and low VIX, and knowing how to make minor adjustments just to be able to reduce the stress of how the trade performs. Now, this week has been just unbelievable because of the fact that the VIX has been so high. The credits we have received on a lot of these short positions has just been astronomical. And because of that, we literally open the day green and stay green the entire day. That is not completely normal. Usually, the trades do present some moments throughout its trading period where you do see a bit of red or you see it fluctuating between its returns. But because of the fact that we've been taking in so much credit, our profit range has just been so wide, and vol has actually been dampened in its performance that throughout the duration of the day, you can see that the trade is doing well and the trade is very green all the way up until almost 10, 15 minutes before the close. So this week has required actually the least amount of management, which most people would find strange considering how high the volatility has been. Usually the assumption is that if volatility is high, I have to be more aggressive, or maybe I sit the week out because of the fact that I'm going to have to do a lot of extra work. But in fact, because vol has been so high, and most of the volatility has been concerns of what might happen overnight when markets are closed and options traders can't actually reposition themselves, then that's where people have had this greater concern. But actually, for the way that we trade, this week has been very low stress. This has actually probably been one of the easiest trading weeks I've had in many, many, many months because of the fact that the market just isn't directional. It can't really get anywhere. And its non-performance with such high volatility is perfect if you are trading trades that take advantage of that kind of momentum or that kind of movement. So let's just get into it. All right. So here you can see the list of trades that we took throughout this week. And you can see most of them have been, massively green, 2,000, 2,000, 2,000, 6,000. so on and so forth. And there have been a couple of red days. So, those, had you maybe not taken those trades, your performance this week could have been well over $30,000. But we take the trades every single day. So there's a consistency to what you're going to see. And no trade system is 100% return, 100% win rate. Any trade that has a 100% win rate probably doesn't have very significant returns. And that would be fine. Maybe that's okay. Just making 50 bucks a day on a trade that has a 100% win rate. But I just don't think that those kinds of trades exist. And all of these trades were very, very, very manageable. In this case, you can see that the trade was up at 26% decay because this was a sell to open trade. So we want to sell high and buy back lower. So you did have opportunity to exit the trade. And not only that, multiple times throughout the day, the trade was hardly 10% down. So if you were seeing that you didn't actually get the right exit for whatever reason, or your take profit hadn't been tapped for some reason, you could have easily exited this trade for a much less significant loss. If you just focus right here, you can see that the trade was hardly down in the 30%, which would have been much less, which would have been less than half of what this loss is showing you. It was literally at the last 30 minutes of the day that we saw a massive drop. And I did tell everybody, if you haven't gotten out for whatever reason, please manage your trade because of the fact that we still had a lot of volatility and implied move left on the trading day. Some of the days this week, we still had 30, 40 points of movement left in the S&P. And I did signal that to the group that you want to start managing your trade because if we get closer to the end of the day, that volatility and that gamma is going to significantly compress and you're going to get a massive move end of day, which can take a paper cut loss of 10, 15% to 40, 50, 60, even maybe 100% if you get a full move of the implied move. So people aren't guessing inside the Discord what they're supposed to be doing. We are really indicating to people how they could manage their trades. But again, just to follow up on the last couple weeks, we trade a lot of iron butterflies. So we often talk about iron butterflies or long butterflies, but we don't talk as much about double diagonals. And that is a trade that we have started to take on a lot more often because this type of trade really benefits a lot from that consolidation move. Because as you can see, as I keep talking about, you get these really beautiful double mountains, like kind of peak returns at these kind of end tails. And if you're looking at any kind of rules-based trading, whether you're using standard deviations, whether you're using Fibonacci retracements and extensions, whatever it is that you're using that's kind of giving you highest potential targets and lowest potential targets, and then selling the movement in between, then as long as a price is consolidating, you really can see very nice returns over time. And on a trade like this, you can see quite easily that, this is a trade, obviously, that has multiple days until expiration. So, we have 14 days until expiration. You can see the dates here, March 27th and 30th. So it's not like we're in this trade for one day. This also benefits people that maybe they have accounts that are, let's say, around $5,000. And so so they can't take any of the zero DT or same day expiration trades, but we do have other trades that are weekly or one DTE, which they can participate then in every time that we do those trades. But having a trade that you can just let bake in the background for 1 or 2 weeks can be extremely beneficial. And as you saw, and I'll flick back so that you can see the returns, but all of our double diagonals last week returned between $2,000 and $7,000. So right now, the max loss on this trade, and usually the trades we're trying to look for something where the max loss is between $1,500 and $2,000. That's really kind of the margin that the broker is going to hold from your account. So if you have a $5,000, $6,000 account, this is a trade that you can put on and still have enough room in the rest of your account to be able to be a little bit more actively trading if you want. A lot of people will say, well, I don't like to risk more than 2% on any trade. But when you have an account that is under $26,000, then the reality is that, it's very difficult to say I'm only going to spend 20 cents on a trade. You are going to end up having to put quite a bit more risk on each individual trade. So it's much better to have like one, two, three really solid trades, which are just like week over week, and it give you some really strong base hits so that you are able to compound that account. You can see that the risk reward is almost 1 to 5. So, you are taking a slightly larger risk for a small account, but it is giving you the opportunity to get that 300-400% returns. And that is consistently what we have been seeing on these trades because really, people have been getting quite easily between 100 and 400% return on these trades, but sometimes within the first couple of trading days. So it also means that this is a trade that you don't have to stay in for the entire duration of the 2 weeks, because if you hit your profit target, then you might want to just take this off and then reset it up for another 2 weeks out. And that is something that we do inside the Discord together. So again, these are trades that people are taking. People are also amending them to their own account to really make sure that they are advantage of taking advantage of all the information that they have. Something that we have taught before at the Trade Speakeasy, some of you may remember, maybe not, but one of the things that anybody should do, especially if they have a really large long-term investment account, is what you call delta weighting. And basically, delta just is the relationship to a stock performance. Sometimes people call it the probability of in the money or out the money. Doesn't really matter. The whole point is that a if you had an account that was all shares, your delta weighting would be 1. And so that would mean that for every dollar that your trades are going up, that you are gaining $1 on each of those shares. And for every dollar that the companies that you are holding drop $1, that you are also dropping $1. A lot of people will utilize things like covered calls or cash secured puts in order to kind of give themselves a little bit of protection, but they're selling those calls and puts really far out the money. So that gives them a little bit of protection, but the weighting is usually around a 10 delta or maybe even a 15 delta. So it means that you're still 1 delta long and only really protecting yourself about 15%. So by utilizing strategies like this, you can really build out a really nice delta hedge for your portfolio. So you get a lot of bang for your buck in one hedge position without having to have 1,000 short calls and 1,000 short puts. Because the annoying thing about single short calls and single short puts is that when you get breached, then all of a sudden you're really starting to have to manage trades aggressively, figure out, do I want to sell my shares at this price? Do I want to get assigned shares at this other price? Like, you have a lot of kind of mental maths that you have to do for your trade management if you do get breached. And so, two things start to happen. Either people start selling their short calls and their short puts really far out the money, so they're not really actually making very much money. So it's not helping them beat the market by any stretch of the imagination, but also because they're taking in so little credit that when they have a really strong negative performance and an underlying, they're not actually hedging themselves. They're going to lose $50,000 on, 300 shares of Microsoft, but they're going to make $400 on their hedge. That is just an irrational, that's not a hedge. That's just some kind of like emotional masturbation that, like, oh, okay, it's there, it's doing something, but it's not actually providing real strength to your account. And it's not really providing you those kind of increased returns. So you're not really beating the market. You're just kind of making yourself feel a little bit better. And
So one of the things that kind of triggered this thinking about what people are doing with their hedges is because I had some podcasts playing in the background, and then a gentleman came on and he was talking about the fact that, basically since November, his account has been flat. But most of his account was actually tech facing and software facing and cybersecurity facing. So I did think that that was a little bit odd because those sectors of the market have had significant drawdowns. And so I felt like he wasn't necessarily being completely honest about how much he was losing on his leaps and how much he was losing on his share performance. But then also his recommendation, he was super excited about adding these short puts. And the short puts were going to generate him about 1% return month over month, or maybe even every 2 weeks, depending on the performance of the underlying, while all of those stocks are between 10 and 20% in drawdown. And I just thought that is such a wild comparison of like how much you've lost based on how much your hedge may return you, that I thought it was quite disingenuous. Because one of the things is that right now the markets are flat. So even though you have sectors of the market that have had significant drawdown, unless you have heavily overweighted your long-term share portfolio in commodities and energy, you are seeing a very significant drawdown. So one of the benchmarks is that you want to beat the market. But right now, if you are too tech facing, too crypto facing, you have significantly underperformed the market with the expectation that, like in April, that you get this kind of massive swing back, or that over time you get an ongoing growth outperformance in those areas, that over the next 2 or 3 years you kind of recover those losses. But overall, that's not really how you want to be managing a portfolio. You do want to be trying to make sure that you are not so heavily overweighted in very specific sectors that if that sector has a significant drawdown, you are heavily participating in the drawdown. And that is something we talked about in the last couple of weeks regarding stage analysis and really focusing on dollar cost averaging on the way up, but not dollar cost averaging the entire way down until you see these really nice bases. So one of the reasons why we've started doing these double diagonals is because on a very small amount of money, you can get very significant outsized returns, and that will allow you to hedge your portfolio. Last week, we did, but the 3 double diagonals we had, 2 of them performed over $2,000, and the third one returned in almost $7,000. And that is a very nice return on a very small amount of risk overall. If you had done all three of those positions, you wouldn't have even needed $5,000, and you would have only been holding those positions for 1 week, for 7 days. So from the Friday to the next Friday, you would have been holding those positions. And something like that, having a trade which is allowing you to really play the downside, is not having a very significant drawdown on your account if you get a strong bullish move in the indexes, so because the rest of your account is going to perform really well. But if you can continue to consolidate, if you continue to have a slow, easy drop down, you will have a really nice performance. Unlike just doing long puts, which, yes, you might be able to catch these moves down, but they're very difficult to catch the very top and then the very bottom, where you want to get out of those positions without constantly staring at your screen and watching the VIX and watching the index you're playing and A, B, C, D, where something like a double diagonal is just baking in the background and allowing you to make money in a much less stress-free manner, and not having to have so much discretion every 5 minutes on the trade, because the markets have been choppy. And so, with long calls and long puts, if you don't get in and out, theta can really start to just blow up your positions. So, I did want to just mention that with double diagonals, you can actually, this is not a position that we're in, but there are a couple members, because they are hedging very large portfolios, they've decided to be playing these double diagonals, but much more directionally. So right now, I just want to make it clear that right now, this isn't exactly correct because of the fact that both the futures market and the options market are closed because of the time it is on Sunday. So you would want, you could screenshot this trade and then go back and try and reset it up to see what the max loss would be. The max loss should be much closer to about $1,500, not $2,600. But the cost of this trade would be about $1,700. And reason being that at the moment, the put side positions are almost 100% more than their normal average value. So here you can see I've set up two diagonals, and those are both put side diagonals. So essentially it means my entire thesis is really hedged to the downside. And here I am saying that if 90% of my portfolio is long shares, then I don't mind having 3-4% of my portfolio only positioning itself to be productive if there is a downside move. So this trade will lose money if the S&P makes a massive pop up. And right now that has been, the S&P hasn't been able to break down, which does mean we have risk to the upside, which is why inside the Discord, we are playing both sides of the trade. But that's because we're considering an account that is only active options portfolio. But if, like I said before, you consider your entire account and 95% of it is long shares, then you do need to be more aggressive in your hedging to the downside without allocating too much cash and being in positions that you can manage. So let's just move out the range a bit. The nice thing is that if at any time during the next week, the S&P drops below its current price and moves anywhere down to the 6,300, this trade is going to make money for us. And the longer it stays down below the current price, which is around the 66.30, the longer we stay down in that area, the more this trade is going to return because this trade significantly benefits from time decay. So as the time decays, you can see that this red line starts to pop up, and that starts to give you much more significant returns. So if for some reason on Monday we get bad news and then we get more bad news, we're going to see this trade significantly outperform. The other thing is this trade benefits from volatility increasing. So if the VIX were to go up even ever so slightly, watch here as you see the max profit increase. So if the volatility, so normal volatility right now would give us a max profit of around $8,500, but any slight tick up on the VIX, even if it is only intraday, and it doesn't actually stay that high, at any point, if the VIX were to pop up, the returns on this trade would increase by 50-60%, which means that even if we only held this trade until Monday or Tuesday, we could very easily see a 100 or 200% return on this trade setup. And, for someone if somebody is trading a $100,000 account, or maybe their IRA is worth $100,000, having a trade like this that gives you a $3,000 return, that is giving you 3% with one very small trade, which is dominating a very small section of your account. And though you may be facing drawdowns of more than 3% return on the entire account, it is allowing you to buffer some of those losses, or at least allowing you to dollar cost average into some of those shares that have already faced these 20-30% drawdowns. Now, something I do want to talk about and I want to draw your attention to is the fact that the last couple weeks, a lot of trading gurus have been talking about now is the time to get into CrowdStrike, Net, APP, the cybersecurity, the software stocks, because those all got smashed because of these latest updates with Claude and other AI providers that are competing in this space. And the fact that on earnings, a lot of these companies haven't necessarily been able to properly position themselves on how they're utilizing AI to really increase their bottom line and decrease their capex. Now, CrowdStrike did do a very good job the week before last, which is why it did have this pop back up. But something you want to be really, really cautious of is the fact that, yes, we had this move down and then this bounce back up. But the reality is that that return, that bounced us right back up into the trend line and not all the way back up into our supply zone. So what would have been much nicer is if we had this pop down, pop back up, and we came all the way into the zone, then had a pullback to the trend line and then a bounce back up. Now, that is still possible with CrowdStrike because of the fact that we really haven't rejected yet. But it does look like we're slowing down, and we are slowing down at the trend line. So that's something that you do want to be careful of. Now, CrowdStrike has a much better setup than some of the others like APP, which did have this negative situation. We had a very nice rounding bottom inside of a beautiful demand zone. And instead of creating these higher lows and then breaking us above the trend line and then having the retest and then bounce back up and then coming into this zone or coming all the way through this supply zone, we actually rejected at the very bottom of the zone, which often means when that happens that there were a lot of trapped buyers here that just want to get out of the position. So yes, we were very oversold. We got a really nice bounce back up, but this area may have been a key area for a number of maybe options positions or selling positions or some other strategy, or even shares that were scaled in at this price where people are saying, you know what, there's just too much weakness. I've already suffered way too much drawdown. So in fact, I don't want to hold on to those shares. And then you get this flush back down. So we do need to be careful because the bounce off of oversold readings did happen across a lot of different underlyings in the software and cybersecurity space, but they've all started to reject in their last key supply zone. Net is another one. This had a really, really beautiful return after their last positive earnings, but we have so many lower lows. And actually, we've had a really strong trend line, but we haven't had any higher lows. And that would have been nice to see a much more stable kind of bounce up instead of seeing what looks like a really strong mean reversion trade, because oftentimes those can be given back as quickly as they were created. We are obviously just above that downward trend line and we are holding. Hopefully that means that we can see some kind of new zone formed here and then a move back up. And then hopefully we don't get trapped in this supply zone. And then we try to give a natural move towards this last origin area, that this high that put in this significant low with a really nice double bottom. So we'll see how all of that works out, but it does mean that you do want to be cautious because of the fact that CrowdStrike is already kind of showing you a rejection at the trend line. APP gave us a rejection at the trend line, and Net is trying to decide what it's going to do at this resistance level. So again, this is part of knowing what you are trading and why you are trading it. If you're trading it because you're looking for gamma squeezes, if you are trading this because you are looking for oversold or overbought readings, and since everything in the software sector was very oversold, it was, it was a nice trade to kind of catch that mean reversion. But now you do want to be cautious and especially start looking at your shares to see what your average price is and where that is in relationship to the overall value of some of these companies that could continue to struggle as AI continues to rapidly develop and continues to impact this area of the market quite specifically overall. All right, friends, I hope you guys have a great week. We would love to see you in the Discord if you're interested in learning how to trade any of the systematics or how to just hedge your portfolio or watch us trade and see how we chart out underlyings and how we use supply and demand zones and gamma, then feel free to join us. If you like these videos and would like to see more of them, not just our weekly trades and the return on our trades for the Discord callouts, but also if you would like to learn more about how we trade calendars and diagonals or iron butterflies or double diagonals, let us know before. We would be very happy to share more information about what we're doing and how we are doing it. All right, I will say bye for now, friends.